Man, we clean up nice in that picture, don't we?
Doesn't take much, right?
You look better than I do, I'll tell you what. Hey, happy Friday. Hi, investors, traders, market watchers. We are Todd and Ryan of New Age Wealth Advisors. Friday live stream. Good day to you, Ryan.
Good day to you. It was a lot happier before the inflation report came out this morning, but if you're invested for the long term, maybe looking for some buying opportunities at some point in the near future. If you're going to make light of or find the glass half full argument with what's going on today, but that was heading Friday afternoon, seeing what markets are doing. Not really how you love to head into a weekend, but it's the nature of the beast, right? This is what being invested in the stock market is all about, and you got to take the highs with the lows. And today, probably a little bit more of a low day as we're kind of entering this early afternoon phase.
That's all, guys. That's the show. Just got to take the highs with the lows and have a great weekend. No, just kidding. Yeah. No, I mean, but were you surprised? I mean, I think the expectations, looking at the notes, I think there were 8.3 on the headline. It came in at 8.6. Let me just get the show notes up here. I sit behind like 4 monitors, and it's not to trade and invest, it's to run media events like this. So headline was 8.6, expectations at 8.3 year over year. Monthly was expected at 0.7, came in at 1. The core, excluding food and energy, was 0.6 on expectations of only 0.5. Year-over-year core was 6, expectations of 5.9. So, it beat expectations, but it wasn't horrible. We'll talk about this in the show. The Fed Fund futures market shifted quite a bit, and this is something we've been focusing on a lot. Shifted the probabilities of the June, July, September meeting based on this. So, I don't know. I mean, were you that surprised to see it? I'm not, and I want to hear your answer. But the market was really surprised, as evidenced by this change in where the Fed's going to go in the next 3 meetings.
Market was surprised. I mean, we've been trading kind of flat the last couple of weeks, right? Some big up and down days, but usually a good day, maybe a bad day following it. It's been relatively flat. I mean, we had to sort of expect this to be bad. I think the White House was coming out earlier in the week, sort of giving us notice that the expectations are not going to be good. I think the biggest frustration was
they did that last time though. They did that 2-3 months ago, and everyone was expecting like a 10 handle print, and it went out the first time it was at 8. Do you remember they did that two prints ago? I think
I do, and I think what we saw last month for April's reading, right? We were kind of feeling like we were plateauing a little bit, maybe even coming down. The rate of increase was coming down.
Right.
Felt like we were getting to where we needed to be, but this one, going up higher. We know we haven't hit peak inflation now. I think that's frustrating the markets. And again, I talked about it last week. I think what we were starting to get into the phase. It just feels like everything's trading on the Fed right now. Like everything is based on what the Fed's going to do with rates. We sort of have our expectations. They came out over the last few weeks saying what they're going to do in the coming few months in following a couple of their next future meetings. But this kind of puts, you were talking, we'll get into it. This changes what the expectations are a little bit. And the increase of higher than 50 basis point rate hikes, may be on the table, or at least the market's expecting that a little bit. And again, that just leads to more uncertainty. Markets don't like uncertainty. I think we were all wishing and hoping we would hit that plateau, but we're, to an extent, it shouldn't be too surprising with all the instability overseas still. We're seeing energy still on the rise. I mean, we're now over $5 a gallon here. I think the national average is over $5 a gallon. I mean, that's eating away at people's, paychecks and spending ability. Groceries are up. I mean, we're seeing across the board. I think we're just hoping for relief, but we're not seeing it. And the areas of the market that are going to be hit the hardest because of this are being hit. We're
Yeah.
seeing that direct correlation as to impact of inflation and as well as the impact of rising interest rates. So yeah, it wasn't a great reading, and markets following suit with it.
Yeah, yeah. You're just diving into the report here this morning. And by the way, great job covering last week. Ryan ran solo last week, did a great job. I hope you guys enjoyed that. Go back and watch last week's show. But looking in the CPI report from the BLS, Bureau of Labor Statistics index right here, and you hit the nail on the head. I think we were kind of relying on energy being the one kind of source of inflation because of heightened geopolitical pressures with tensions with, unfortunately, the Ukraine situation is still continuing, and gas, gasoline, crude oil, and natural gas continue to push. But in this report, we saw shelter, and the big one was food. Food was a big increase, both at home dining and going out. So just kind of reading through the report. Most major components increased over the month. Large contributors were indexed for shelter, airline fares, used cars, trucks, and vehicles. So here we go again with car prices, both new and used. So yeah, it wasn't great. We could kind of take a look at some. I'm probably one of the few guys in the world who does this, but I do want to look at the technicals and just run this by you with actually this data. I threw sort of a long-term trend line on top of CPI. Let me just pull this over here. It's interesting. You can, I don't know if anybody in the world watches it, but this is quite interesting. I think it puts it in perspective. So this is the year-over-year percent change increase in the CPI Consumer Price Index going back to 1920. So just get your crayons out and connect the highs of the pre-29 crash into the roaring 50s there. Coming out of the 70s into 1980, and then we're right there at 8.5%. So, is this historic? Yeah, it's just because it's happened so rapidly after 40 years of just benign price increases. But perhaps the market being led by interest rates and stock market movements, we're going back to something called price discovery. And I was born a trader. I've always traded the markets. In the entirety of my 20-year career, we haven't had a lot of price discovery, and it seems like the markets might be going back to that, just as evidenced by this chart. You can see there's a lot more swings. There's a lot more safeguards. There's a lot more technology, squashing volatility and keeping spreads very thin. But we might really be in a regime of increased volatility. And RB, I'm sorry, bro, you launched the wealth management business with you're like, we'll put some tech stocks on, buy FANG like we did the last 5 years and make a bunch of money for everyone and ourselves. But no, we're going back into a volatility, an increasing volatility regime. I think that is sparked by interest rates coming out of this long-term range. So active management, I know you're sick of hearing about it, but active management is going to be here, whether you like it or not. Look at what bond markets are doing. The crypto is useless. Bonds are not offering any kind of safety. It's active management specifically in stocks, and I feel like that's a big reason for it. Rant over.
Yeah, this is an interesting chart, and I'm thinking as you're talking about that, I'm just thinking about the last 2+ years, right? Maybe not quite 2.5 years, but a little bit more than 2 years when we first got into this COVID environment. And there's just so much that is still being shaken out, right? That it felt when markets bottomed and started recovering, 2 years ago this time, we started this really sharp increase for the rest of 2020 and then into 2021, where we had very little volatility, almost a straight line up with the markets.
Yep.
And I think we probably felt a little bit, I'm saying just we as in financial media, investors, everyone that we're just things are just going to be normal. And obviously you couldn't predict what's going on with Russia and Ukraine. I think that's having a pretty big impact, especially as this is lasting longer and longer. We're going to start seeing that impact overseas, especially with Europe, and that impact on some of our larger companies that are doing a lot of business overseas. The impact over the overall, energy market. I mean, that's going to have a lasting impact right now. But to sort of come out of COVID and not seeing like a shakeup that we're seeing now, I think maybe more people were kind of wishful thinking. I mean, you don't know how it's going to present itself, but I think just this normalization coming out of it is we're seeing the impacts. And, you know, we didn't even talk about with inflation right now, you know, Shanghai's still somewhat on lockdown. You know, China, a huge manufacturer, you know, the supply chain issues coming out of there. I mean, there's just been so many issues that we're still dealing with that I was always in the camp that, yes, I think inflation was going to be transitory because of this shakeup and everything that happened. It's not going to be long lasting because we are going to normalize. But this normalization process is taking much longer than I think first expected. And, you know, those two big elements overseas with Ukraine and Russia, as well as lockdowns in China continuing, which is crazy, it's just having a huge impact here. So, yes, maybe it's transitory, but maybe that transitory sort of definition is, you know, you went from a couple 6 to 12 months, maybe it's going to be 2 to 3 years, and
we've had 40 years of it, as we just saw, like nothing more. The Fed was, you know, was dying for sustained 2.5% inflation to prevent becoming another Japanese deflationary. Obviously, there's different demographics at work here than there is in Japan. And you know, it was interesting. You talked about China. You know, I think I'm trying to remember when they started going after certain companies in China, specifically tech-related, media-related companies that were making too much money too quick, and the whole sort of society is not accepting of obviously outsized gains by Chinese tech companies joining in the Western tech boom, that this digital boom that I continue to believe that we're still in. And the Chinese government was very public in clamping down on that. I mean, look, they disappeared Jack Ma for a couple months and then they brought him back. But that was a real thing. So China has been verbally trying to slow down their economy as well. And that's what's creating this issue. Obviously, we know where European growth is. We're far outpacing that. China, as I mentioned, is trying to slow the brakes and keep the communist mandate in play. As you said, their lockdowns. Emerging markets, you know, they have a lot of debt denominated in U.S. dollar, and I do want to take a look at the dollar today. So even though commodity prices are going up, and a lot of emerging markets are commodity-based exports are doing well, dollar strength, it really hurts their ability to service their debt because a lot of the emerging market countries are unfortunately very much in debt, and as the dollar gets stronger, it's harder to service that debt. So the U.S. continues to be the only place. And how many portfolios have you and I seen come across our desk that are loaded with emerging markets? Guys in their 40s and 50s with emerging markets. You want to talk about that quickly?
Yeah, I go back to there's different ways to think about it, and to me, the market as a whole, I think, has evolved, you know, especially over the last 5 to 10 years. But when you look at long-term trends, I think we talk about this reversion to the mean so often, and you know, you kind of see a historical pattern of U.S. stocks outperforming for, you know, I don't know, let's say 5 to 10 years, and then maybe it reverses, and international, whether it's developed or emerging market, have that strength versus the U.S. markets for, you know, again, you know, 5 to 10 years. It may be different from time to time, but
yep.
You know, when you take a step back, so emerging markets are, I think, historically have been, and even in the future are going to be really volatile. And I think when you take into account how much of an impact China has on the emerging market indices,
yeah,
you know,
it's like it's
you don't
over
know
half. It's over half of most of the ETFs. Yeah.
And if you know, do you want to be invested in that, you know, regime? And there's just so many unknowns. You don't know what you're going to get with it. I mean, that's a little scary. And then you think about developed markets. I mean, how many companies? I think it's always good to kind of look at more of the underlying holdings, right? I mean, we've seen, notwithstanding the recent pullback on U.S. tech companies, right? They've had a pretty big pullback, but for the last 10 plus years, they've been the place to be invested. When you think about developed international markets, they don't have these, you know, groundbreaking companies. You know, they're more in kind of like either defensive sectors, consumer cyclicals, other areas of the market that just have
financials in Europe.
Financials.
Yep.
Yeah, and they just haven't had the growth and the strength. And I think, you know,
that's a good point.
I'm with having diversification and whatever that means for your portfolio, and not having all your eggs in one basket. But I do think we have to sort of step back and say, like, what are some of the reasons for the swings historically? Where do we see future strength in some of these areas? Because frankly, European country GDP, their economies have not been strong. They're not, they don't have these groundbreaking technology or companies that are coming out by and large like we do in the U.S. I just think right now the U.S. is just a great environment to
for sure.
Build and run businesses. And
in the presentation that we did, you look at, you threw a great stat in front of me showing the top 10 market capitalizations of S&P companies, and GE was at the top for so many years, and then over the last 10 15 years you watch how not only that, but it was a very wide, very even distribution, I guess, of the top 10 market cap companies of the last 20 years. And then as we get into the 90, or actually no more, I think it was a 40-year stat, so you get in the last 20 years, the top 5 start to far outpace the bottom 5, and they're very much technology. But the technology, the top 5 market capitalizations, have a lot of international exposure as it is. So by owning S&P, owning Apple and Microsoft, you have massive international exposure. And I just want to show you this. This is the Vanguard ETF VEU. So this is all world ex-US. So this everything else in the world ex-US. So you can see the stock was in 2007 was at $60 or $55. It's still there. No growth. And this is actually just you just take the price of VEU, divide it into the S&P, and if this chart is going down, that means VEU is underperforming the S&P. I mean, it's very clear, you can see that. But you look at the underperformance all around the world compared to the U.S., there's no signs that this is ending. I don't want to get too far off on this. We really didn't even talk about going down this way, but I think it's really notable. One thing I do want to go ahead.
I'll just add in. I think it goes back a little bit to what you said earlier, and having a little bit more of an active approach. I mean, we see, again, from clients coming in, maybe it's from other advisors, or again, I read and hear advisors that really push investing is so simple. Just put, let's just use an all equity portfolio. 60 in U.S. stocks, 40 in international. And listen, you can make the argument if you want to say that's the best way to do it. If you look back over the last 40 or 50 years, maybe it cuts down volatility. You're going to get overperformance, underperformance. But if you've just been taking that approach for the last 5-10 years, you're going back to that VEU chart you just showed. You're greatly underperforming. I think you have to really figure out what you're investing in for the future. And you brought up a really good point that our biggest companies in the S&P are so tied to international markets in terms of where they're generating revenue, where they're doing business, that yes, they're US-based companies, but they're still, we live in a global economy. They're still tied to the international market. So, people will bring in the home country biased argument.
Yep.
I don't know. I think you sort of know what you're getting here a little bit more, and we continue to build and break out great companies. And
sure. Let's move on. We have so much more to cover. I love this discussion. And let me just bookend that right there. EEM, this Emerging Markets ETF. I'm not saying emerging markets is a terrible investment, because using that same ratio, this is EEM, Emerging Markets ETF in the S&P, coming out of the tech bubble crash, 03 up to 09, and the credit crisis, EEM was the place to be. But then ever since 2010, no thank you. It's not hard to use simple technicals with long-term investing to say, maybe there's going to be a time where the U.S. growth has peaked out and emerging markets are going to rotate back in. You're going to see it here. You're going to see it in the fundamentals, but you're also going to see it in the charts. So let's circle back here. Good discussion there. Another data point we got to talk about. More bad news. Sorry, bro. U.S. index of consumer sentiment, new lows. Prior low was 1980, which we saw that was a major inflationary spike. 1980, 51.7 was the prior reading. We just rung the 50.2 bell. So sentiment continues to be much worse than the COVID lows, even worse than the global financial crisis, where we almost lost the financial system lows. That
I think this is a perfect example of what we're seeing in the market today. Just the impact that inflation has on people's psyche, how it truly impacts everyone, all of consumers, everyone in the market. I mean, I think when we started seeing those higher readings earlier this year, inflation really makes people weary. It really scares them, and I think that's what we've seen so far this year. And today's report, no different. I mean, this drives down sentiment for sure. And it was I couldn't believe when we were looking at that number 2 or 3 months ago. It was below the COVID lows, and that was amazing to me. I mean,
yeah, I know.
It's because the economy is still, at the end of the day, the economy is still really strong right now. And
I don't know if you believe, I don't know if you're on board, but I still believe it's a function of why we named the business what we did, which is new age wealth. We are in the digital information age. The speed and dissemination of information is a magnitude more quicker. I can't even speak. It's Friday. It's just information flows so much more quickly, and so many media outlets and social media, and everyone's grasping for attention, and it's everything they can do to scare you. I mean, I'm so sick of YouTube commercials telling me about the next crisis that's coming. I think a lot of it has to do with that. I really firmly believe that. Like yield curve inversion, I'm sure 9 out of 10 Americans heard about yield curve inversion when it first came out 6 months ago, where multiple times yield curve inversions happened in the past. I bet 3 out of 10 of Americans actually heard of it. I don't know.
Yeah, and we were seeing last week, and I think today's a little bit of a divergence from this, is that, and I talked a little bit about it, is that because of what the Fed is doing, we started kind of getting into this good news is bad news is good news for the market, right? Because good news in the economy still means that, hey, we could see inflation still going up because demand is hot, right? If the Fed is trying to cause a recession, so if we're still seeing strength in the economy, it means the Fed may need to still step in with higher rates. So good news in the economy would be bad news for the market, and vice versa. I mean, when we had the bad news from Microsoft, Target, we had some actually up days in the market, and that was really surprising to me, given the fundamentals, right? If we get lower earnings, I think. Right now, everything is just based on inflation and what the Fed's going to do in those expectations. And we're seeing today. Today's kind of like, because this high inflation's bad. I would say bad news for both, consumers as well as we're seeing the market right now. And until we can kind of get that peak there. And I thought we were getting close last month, but maybe we're not quite at peak or flattening just yet.
Yep. And Gerard and Ziad, I see you there. Ziad, sorry for pronunciation. Yeah, both asking about gold and silver. I will definitely throw them in there. Appreciate that. Any other questions, throw them in the chat. Okay, let's, good talk there. Let's transition a little bit. Let's talk about GDP. So are we in a recession? Obviously, we had the first quarter of contraction. We have the next reading on June 29th. So we have just over 2 weeks. And the probability right now, expectations as of now, is still a positive GDP print. So just reading a quote here, the Fed has lowered the GDP outlook for the U.S. from 1.3% to 0.9 for Q2. Right now, that's what we're in. So it's reduced by 30%, but it's still positive. So technically a recession is 2 quarters of GDP contraction. I was listening to the guys on Fast Money argue with each other, and Jim Lebenthal, who I really like, and I know him. He's like, there's a recession. We're seeing the economy contract, but it's coming from a strong position that it was pre-COVID and all the extraordinary fiscal and monetary measures that the Fed put in. The economy was already strong, and then they put a couple extra trillion into the economy to make it even stronger. So we're seeing economic contraction, but it's coming from a very strong point of view. Earnings season is going to be very important. Jim and Josh got in a big debate because, it's TV. That's what they do. Josh is saying earnings doesn't matter, and just look at the technicals. Like, okay, I guess. I mean, we can look at the technicals all you want. But the economy's contracted, yes, but earnings continue to be very strong. I want to talk about the retailers a little bit. I want to kind of put some numbers behind the retailers and how the consumer is being squeezed. But are they gonna stop shopping? I had a discussion with someone that Ryan knows well. He's a very prominent businessman who owns and Ryan, stop me if I shouldn't be saying. I'm not gonna say too much. But we're discussing, did you see the downgrade? I think it was Altria was downgraded by, I don't know if it was UBS or Goldman or who downgraded them, saying that cigarette demand is going to decrease significantly in Altria, like one of the most stable, 5-6% yielding staples out there, was down 6% in a day because they got downgraded on cigarette demand. And you know who I'm talking about. You know what I'm saying? And I'm sorry to be dodgy.
I think so, yes.
Yeah, and he's like, he was telling me, I don't smoke, but he was telling me that a pack of Marlboros, I guess, is like $11, and he's like, the next, like a couple steps down, you can get them for $10. And I said, well, if you're a smoker, I mean, I don't know, I don't smoke, but I said doesn't seem very elastic to me, and I thought that downgrade was really, really funny on Altria.
Yeah, it looks like Morgan Stanley downgraded him.
Okay.
Yeah,
I thought that was it. I just laughed at that one. I was like, what? Anyways, go ahead.
I was just saying, I know there was I think CNBC just had a study that, prediction from talking to CFOs around the country of expectations of a recession early next year. I mean, whatever it is, I mean, to me, I think the biggest thing is, right, it's underlying strength of the economy. And I think that was a good point you were bringing up with Jim Leventhal. He was saying, we're coming from this position of strength. And that's a good thing, right? Because we've had some real instability over the last few bear markets we've seen the last 20 years. Not every recession or bear market is going to look alike and be the same. The other thing to remember, especially more as just investors, just like sticking to a longer term plan, is that once we're in or at a recession, the market's probably going to be recovering.
Right.
And, I think that's the big takeaway for me, talking to clients and talking to, individuals or prospects. It's, if you're either sitting on a lot of cash or thinking about, trying to come up with a plan to get, your portfolio going, or you're just indecisive or you're scared of kind of what we're seeing right now, totally understand that. And can't blame you, because there's just so much uncertainty around the world.
Right.
But at a certain point, we're going to see this market recover before the economic numbers are telling us, it's as bad as it could be. And we got to keep that in mind.
True.
The economy is not the stock market. They're closely correlated, but you could look at charts. There's typically a 12 to 20 month, or I think historically, I've done some presentation on this, about a 9 to 20 month sort of difference of when you get a stock market peak versus an economic peak, and vice versa on the downside. And so you got to keep that in mind. And if you're thinking, hey, we're going to, if things are only going to get worse if we're going to get a recession later this year or early next year, and you're running for the hills because of that, you got to take a step back and understand that, the market's not going to be in line with that. And it's what's always so hard about, especially sitting in cash and trying to get back into the market, is that when that market is recovering, the worst news is going to be coming out, and you're going to be telling yourself, hey, this thing's going to come back. There's going to be a better buying opportunity. And at some point, you're going to realize, I missed that buying opportunity.
Yeah.
Then what do? Do you buy in at 10, 20% higher, or do you wait it out? And this is where, investors over time run into so many problems from a long-term perspective, because, think of what if you miss the first 2 or 3 years coming out of 2009? I mean, you can never get those years back, and that's what you got to keep in mind. And so there's so much of an emphasis on the recession and talk about a recession in the media, as you alluded to, but there's other factors at play, and don't make all your investment decisions based on the recessionary numbers or
right.
When you think that recession is going to happen.
And I think people, our clients, and I think people we talk to and clients, I think I know they're smart enough to know, let's get on with it. I hope there's a negative GDP print in 2 weeks, and let's get on with it. It could be a short-lived recession. And to your point, stocks discount what's going to happen in the future. So we will go into, we have a lot to cover still. So we did raise cash. I think we talked about it 2 weeks ago. We raised cash from a growth portfolio. We actually have a little bit of a hedge on. So we are defensive, but I sit behind 6 yards of monitors and watch the market every single day. The at-home investor should not be doing this. So yes, I am gaming it just a touch in the growth portfolio. We have about 10. Go ahead.
But I think there's a good distinction, right, and a proper distinction of raising 5-10% cash versus going all cash. And there's a big difference, and we see people who do that. And I think there's a difference of being tactical in terms of what's going on in the immediacy versus market timing. And this is definitely
the discussion you and I had, because you're not coming from this world where tactical in and out. I mean, I really had to lobby you even to go to 10%. And then guys, please click the like button. I got Ryan to agree to let me put an inverse ETF in the growth portfolio. I was like, boo. I mean, you made me prove my case, my point to you, and I respect that. So, no, it's all good. But key distinction, not going all in and out, raising 10%, putting 4%. We have 15% protected in the growth. We went 5% in the tactical dividend portfolio. So, yeah, we are being a touch defensive, but finger on the trigger when it feels like we have that capitulation, and it again, darkest before dawn is when we'll put that cash to work.
And that's the strategy, right now, in terms of you're thinking of more of a growth strategy versus a value type strategy. The growth is obviously is still more volatile. Trying to find the right opportunities there. I think you can be a little bit patient right now with that exposure. And so when you take a step back, you can be tactical in a shorter term sense while still being invested for the long term. And to me, that's not a market timing strategy, right?
That's a good point. That's a key distinction. We're being very tactical in the short term while running longer term portfolios. Okay, let's get back on. I love the discussions. So let me just show you what the Fed. This is where we got off talking about GDP and where the Fed was going to go. So. All right, Ryan, I need your CPA brain here for me. You got to keep track of some numbers for me. So current Fed funds targets, you got it? 75 to 100 right now. That's the Fed fund target. Coming up in June meeting, we're going 84% chance going 125 to 150. So 50 basis points is in, and they even put 75 on the table. Okay, so after June, we're going 75 to 100, okay? July, now that we're at July, now that, come on, baby. Now that we're at, what did I just say? 125 to 150 will be the new Fed funds in July, right? This is interesting. So they have 47% chance that we're going 175 to 200. So 47% chance we're going 50. They just put 200 to 225 on, equal weight. And I think looking at these stats, 200 to 225, we're at 45% chance. A day ago, we were at 19%. A week ago, we were at 11. So they just put 75 on the table for July. Right? So, okay, so we have equal chance of going 175 as the base, 200 as the base. And then September, depending on where we go, this is where it gets harder going 3 meetings out, 175 to 2, one of those. So then 175 to 2, there's 50 again, and then they put 75 on for the September meeting, which a week ago, that was nowhere near. So we had 250, 275, 45% chance. A day ago, it was 13%. A week ago, it was 7. I'm like, this market is like, this is the kind of stuff that, I mean, the Fed Fund futures is throwing their hands up saying 50 wasn't even guaranteed in September. Now they're saying a 45% chance of a 75 basis point hike. It's all over the place.
Only defense against inflation right now, and so I mean that's going to be the theme, as we enter into the summer and these next few months. It's going to be interesting when we look back in 5-10 years and just kind of reevaluate what the Fed has done over the last couple of years. throughout all this. And I know they have more data than any of us have at their fingertips, but man, it's pretty shocking to see where we're at and how much further they have to go in what they've missed over the past 1 or 2 years. And I know it was so crazy coming out of a pandemic, but man, there were signs, even last year that, hey, we're kind of getting on solid footing right now. And it's unfortunate what the impact is today, but I guess it just sort of delayed this volatility a year, right? If the Fed started doing this last year, we probably just would have seen volatility sooner than what we saw. So maybe at the end of the day, it's not going to have a huge shakeout, but seeing double-digit inflation numbers, especially for things that everyone is relying on, groceries, again, energy a little bit more out of control, out of the Fed's control, but just seeing the impact on the consumer there. I mean, these are big numbers that people are dealing with, and a big portion of what their week-to-week, day-to-day spending is on, and so it's having a dramatic impact. And like I said, the Fed only has one defense right now, and that's to increase rates.
Yeah, or they can continue to job on it. All right, so let's jump in. We got a couple people asking about the technicals. That is actually up on the list. Let me just hit this quick. Those of you who are technical geeks and like to watch charts like me, this is the most important theme driving us right now. So markets really like to go up, but they don't go in a straight line. So what they tend to do is it's 3 steps forward, 2 steps back, 3 steps forward. Okay, but specifically what happens is within this 2 steps back, a lot of times it sort of does a head fake. It goes down. I'm just drawing here. It goes back up, kind of gets you excited like you're going to go to new highs, and then it breaks down to new lows, kind of crushes everyone's hopes and dreams that this was the low, goes up, head fakes you, goes down, and then it resumes the uptrend, right? So that's kind of what's happening right now is here's the down. We rallied back in March, in April, then we sold back down. All of this mumbo jumbo down here is a floor. It's calculated based on the ratios and swings. It's all this crazy stuff that I do, and it held. It held. We rallied back up, and we're coming back to test it. So this is a key support level. Basically, takeaway, the way we're going to be playing it here is if we break this 35, looks like floor's 35. We're going to be heading a little bit lower towards 3K there, and then the same thing in the NASDAQ, exact same chart pattern is going to be, so here is that down, up, down, these clusters here, these vertical lines are your support level. This is where the market should have stopped. It did stop. This is today's and yesterday's sell-off here. So we're still holding support, okay? If we do break support in the NASDAQ, we could be looking down here. This is according to the methodology that I'm using here. This is not a projection. This is a long-standing 100-year methodology saying if you don't hold here, this is going to be the next level. And as I said, we raised cash and growth. We have an inverse ETF on. We tightened up the growth portfolio. We brought in stocks, tech stocks with better free cash flow, lower valuations. We kind of oriented the portfolio to sort of weather volatility. Okay, so let me just show you here. Rates are going to be key. I need to get a bigger screen. So this is the 30-year yield. Long-term yields on the 30-year did break out. So resistance based on that trend line was right around the 3 level, 331. We did break out. We are pushing a new highs here, so rates are continuing to go. That's the 30. Here's the 10. We're at 314 in the 10. Again, making new highs here. The 10 doesn't have sort of that same what they call trend line. Again, this is using a little bit of technicals. It's close. It's not perfect. Horseshoes and hand grenades. This was resistance about 2829 in the 10, and we continue to break higher. So yields are continuing to go higher. Yields up, bonds down. And what's interesting is commodities are sort of all over the place. Crude oil continues to be well bid into the 120s. And what I find interesting today is crude oil is actually off today. So with today's crazy reading, So we're at 120.70, off just a touch on crude oil. Gold is really not doing too much. I know we don't do anything with gold. 1878, we had a double top up here, tried to break out through 2030 area here, backed off. Gold clearly doesn't want to respond to an inflationary environment. Seems to be more in the last 10 years been responding to a deflationary event. I know we have some questions in there. And then silver, man, I got this on 1080, right? I can barely see it. I got to get a bigger monitor here. So here's silver, again, not responding at all to the environment, backed off from 21. Gold and silver, guys, just continue to be useless. I hate to say it. I know people love to see them, and they've been good performers for a long period of time, but this inflationary environment really hasn't done much. I just want to show you also. So I want to show you gasoline. I have that chart ready to go here somewhere. Gas is a key market here. And we do have resistance, technical resistance coming up in gas. It is hidden right here. Okay. So this is gasoline futures. Again, this is sort of the technicals that we do, just kind of get boundaries and support resistance and sort of get an idea where the market is, and you square that up with all the sentiment and hysteria and all the conversation around it. Technical resistance in RBOB, this is the gasoline futures, comes up at about 4.5 to 4.6. Currently, we're about 4.2. And I know in the city areas, it's going to be higher than that. You said, Rye, you're about 5 in gas. So we do have technical resistance coming up here. Crude continues to be 150 or 120, 121. Can't really break higher. Negative on a big inflation reading day, which I find interesting. And the other one that I'll anecdotally, is that a word? Anecdotally?
Anecdotally.
Is that a word?
Yes.
Okay, thank you. All right. It is on a Friday. Lumber. Let's take a look at lumber. Housing was just cited here. Where's my lumber? Lumber just got destroyed, and I'm going to turn it back over to here in 1 sec. Sorry, guys. Let me just, my old eyes here. Let me pull lumber over, and then I'll flash it back up here. Looking at input for housing prices here. 554 in lumber. We were up around 1400 in the futures. Big old double top up here, 17 sold off here in July. Back up into the end of last year. This is early 22, hung around 1300. And look at lumber coming off. I find that really, really interesting. If inflation is really here, and we could look at a couple other commodities out there, similar charts, it's the energy that continues to be the driver. I found it interesting too. The CPI report had hot housing number, but I think we can all sort of agree that the housing market is cooling off. I think energy continues to be a main driver of the hot inflation numbers. That's why we continue to be overweight energy stocks in both the growth and value portfolio. We added some names there that continue to do extremely well. And again, just like I have finger on the trigger to get rid of the cash and the hedge we have in the growth portfolio, right, I can't wait to take some of these energy positions off. We're like 3 and 4x the weighting in energy compared to the S&P, right? It's only like 4% in the energy representation of the S&P. And Kramer brought up a good point this morning. He's like, we could have a long way to go. The fact that energy is so key, and I think this geopolitical tension with Russia reminded that the most important resource for a sovereign nation is their energy supply, and the fact that it's only 3 or 4% market capitalization of our economy, according to the S&P 500, is, I think, a little telling that it might need to gain some more market share. So while we've enjoyed some really good gains in energy stocks, I'm not overly quick to want to take profits on those, because I think that's a smart observation that energy might gain more market share. Clearly, green energy and clean energy is a lot longer away than we realized, and companies are going to have to continue to go back and reinvest in exploration and drilling and get our energy supply back up, because it is clearly not a demand issue right now. Even at these prices, it's a supply issue.
Oh, no doubt. I think
was
I know
I not
we don't
showing
have it
the
in front
chart
of us.
the whole time?
There was up there earlier.
Okay.
I know we didn't talk about this beforehand, but I just, to your point in terms of how the energy sectors, because when you think about how much the energy sector made up of like the S&P 10, 20 years ago, it's so much different than what we're seeing today, and we're seeing some strength. We've seen strength there over the last 6+ months. But I love seeing the charts of. I think the big one was like Exxon versus a company like Zoom coming out of the pandemic, and how much some of these technology companies just skyrocketed and blew past. ExxonMobil was still, even though energy didn't take up a huge space in the S&P, ExxonMobil is still one of the bigger companies in the world, and they had been traded down so much, especially when energy was trading next to nothing back in 2020. And now you're seeing the strength come back in some of these companies, especially versus some of the COVID era stocks, if you will. Peloton, Zooms of the world. It's pretty fascinating just to kind of see that as a side by side. And I know we didn't talk about it, so you probably don't have it. You might be trying to pull it up, but
I'm trying to do it quickly here. So you want Zoom and
major
Zoom
swing.
and here's Zoom and Exxon. So Zoom IPO'd here in right around 2019, and I could do a percent change, but wow. So Exxon went and retested in October of 20. Is actually, look at that. Zoom topped out at the exact time that's interesting. That's interesting. As soon as Exxon retested the lows is when Zoom topped out, and that was in 20. And that's interesting because there's another I do want to show. I have some stats with the retailers and some margin charts, and it actually corresponds to that. As soon as energy started to come back, it started to impact sort of the margins and free cash flows. And I know we're coming up on time, but go ahead.
That's what we're seeing with like a Target, right? I mean, the energy, just transportation, all these additional costs that we're seeing as consumers. These companies are seeing, as corporations as well, and it's going to affect the bottom line. And, even with the strength in the economy, right, you can still have a growing economy, but these corporations are going to feel it on the bottom line, and that's exactly what we're seeing right now. And I think that may be even, playing into it, not only the fear of rising rates, but this fear of continued inflationary numbers, to your point on profit margins. If we start to see them being squeezed, and cash flow going down in the foreseeable future, again, that's going to bring earnings expectations. We may see some shift there, and that could support maybe a next level down in the immediate term.
Yeah. And I'm reading what Steve A says here. It says, Todd, you're absolutely right. Inflation is related to supply issue. I say demand destruction is the only way we can get out of inflation. Now, I don't think demand destruction. I think we need to. I think we need to re-examine. I hate to say it. I think we need to re-examine sort of regulations and bring supply back on. I still think we have a strong economy. It's going to take a couple of years, obviously. I want to bring Terry Long on, who I'm friends with. He works for me in my other company, and he's a senior economist at Exxon. He's at trading analysis, and I wanted to interview him. We just didn't have enough time to pull together. I'd like to get his perspective on it. But no, we need to increase the supply side. We need to, I hate to say it, deregulate a little bit. And I understand it's going to ruffle some feathers. I certainly want clean energy, and I can't wait. But if even Elon Musk is saying, we need to revisit nuclear and we need to be able to supply the energy, because again, that's the most important resource of a sovereign nation is a protected energy supply. And I think that's one of the biggest things we've been reminded of in this. So
I'll be curious if we see.
Go ahead.
I'm just curious if we'll see more push. You're seeing it even on the left, but more of a push for nuclear energy. I mean, historically, it is the cleanest, most efficient energy. Obviously, there's risks with it as well, as we've seen in the past. But it is one of the cleanest ways to bring energy to the table. I don't know. I'm just throwing it out there, not to get into a conversation about it, but
we have to have a real
point.
We're gonna have to have a real discussion on this, a real national, a public discussion. I feel like both sides hopefully come to the table on this, because I think we can all agree. Pardon my crude language, but this sucks. I mean, I really think we need to come together.
Well, even with energy independence here, right? Like there's just so many different sources of energy, whether it's green, fossil fuels, natural gas. I mean, there's just so many sources that even though we're energy independent, we still have to get energy from different parts of the world, and it's just a global it's just a globally, not regulated, but it's just a global market in energy. And so, it's hard to, because that was one of the questions that kept coming up earlier this year. It's like, I thought we're energy independent. Why are prices going up so much with what we're seeing in Ukraine and in Russia? Because that was having a big impact, but it's just a global market. And I found it fascinating. I was reading stuff where you may be producing fossil fuels in an area, around your country, and you're still getting, your oil from overseas just because of where the different markets and how they get flushed out of a local market where it's being drilled and then refined. There's just so much going on in that world that it's. But I do think a nuclear sort of option could help things in our country specifically. But again, I think we're probably a long ways off there.
Long ways off, yeah.
Definitely something to consider.
Yeah, and I'm reading comments there. PG contract, lumber's thin. Are you saying the lumber futures are thin? That's fine. I don't care. I mean, if lumber demand is there, I don't care. If you talking bid-ask spread or it's a thin futures market, I don't care. If there's massive demand for lumber, I think it's going to be a leading indicator for the housing market, and it's 60% off the highs. So let me know what you're saying there. Another thing I want to throw in that really sort of pressures the situation even further is the dollar. Here's another thing that's a favorite soundbite for anybody who wants to speak poorly of the economy. The strengthening dollar. Excuse me. It's the weakening dollar. It's the crumbling dollar. That's the problem. No, the dollar, first of all, is sideways since 2016 and 17. We've been largely range bound, but we are on the cusp of breaking a new highs. This is the U.S. dollar against a basket of 6 currencies, including yen and Swiss and Australia and the euro. But yeah, the dollar's continuing to be stronger, and that will pressure, as we talked about earlier in the show, our large cap, especially tech or multinationals get a good percent overseas. They're bringing their earnings back here. They're going to have to do a foreign exchange trade, and they're gonna repatriate's not the right word, but bring back less profits with a stronger stronger dollar. So that will hurt. And again, even though commodities moving up, dollar moving up will hurt emerging markets. Dollar is breaking out. Again, that will ultimately pressure commodities because commodities are priced in dollars. The higher the dollar, the lower a commodity, including gold, will be. So dollar breaking out, I think, is key. One thing, a couple other just market observations. I just want to throw you. I'm just going to high speed these real quick. VIX, and I promise I'll have this on a screen resolution where I can see. VIX is well off the highs, and I don't quite understand it. Again, the last I saw, we had we're like 28 in the VIX. We're 28.4 right now. We had a little bit of a spike today. This is the volatility index, trades pretty much perfectly opposite of the S&P. So as the volatility and the fear goes up, the S&P has been lower, and we're well off the highs. This should have made a new high in May. Didn't. We're back here close to the lows. We're significantly off the high, so non-confirmation from the VIX. Another thing that I'll talk about quickly is the two-year note really did just get destroyed. So 2-year Treasury note will be obviously inverse of the 2-year Treasury yield. A lot of debate over the last 6 months about the 2-10 inversion as the 2-year yield has been moving up to the 10-year, and as the 2-year gets above, a lot would say that's yield curve inversion. We broke the new lows here in the 2, so yield curve continues to get flat. And then, Rye, do you want to save this for next week? Talk about free cash flows and margins, some of the retailers, or do you just want to summarize up in our? Do you want to keep going, or what do you want to do?
No, that may be something good to kind of save for next week as we kind of digest what's going on in the inflationary numbers, and then kind of see this next week of movement within the market. I think they're really good points. I think they're really relevant to conversation we had today. But maybe it may be worth kind of diving in a little bit more next week as we kind of see this week play out. Because I'm interested to see it as well.
Okay, yeah, we'll definitely take some time in that. So we'll set the tone for next week, just showing you these are sector allocations, and specifically what we're talking about here is consumer discretionary. We are in the growth portfolio. We're a little underweight. We were overweight consumer discretionary. The adjustment in the last rebalance, we dropped by 5.5% in consumer discretionary, very much related to what we're talking about now, inflation, and we'll show you specifically some of the numbers next week in the retailers. And I found some pretty cool stats I'll share with you. Financials also, we dropped by 7%. We are at 4.5% in the growth, what we call the alpha portfolio. So we have a small exposure, 4.5%. NASDAQ has very little financial exposure. We benchmark this portfolio to the NASDAQ. So the big moves in the growth, we dropped by 7% our financial exposure and dropped consumer discretionary by 5.5%. Increased energy by 1.7 to be 12.25 allocation, which is a lot. NASDAQ actually has no energy exposure. Raised cash, as I mentioned. And we also have an inverse ETF on. This is the alpha portfolio. Same thing. This is going to be the tactical dividend. It's just doing a presentation, so stuff is kind of everywhere here. So again, big move that we've made in the last portfolio. Same kind of thing. We dropped financials quite a bit. We dropped consumer discretionary a little bit. We are pretty underweight consumer discretionary, communications, and financials. Increased energy, and actually raised just a touch of cash there in the tactical dividend, which is really our kind of our core staple diversified portfolio. So Ryan made a really good point earlier. We're making the distinction between being active all in and being, a trader trying to time it in and out. We're shaving percentages. We're moving money around. We're trying to, generate some relative performance compared to the benchmarks and trying to protect a little bit. But we're certainly not trying to time the exact low. We're trying to be a little defensive right now and being in sectors that are working. Clearly, energy is the case, and some other specific names. So. Great show, Ryan. Good points.
Yeah, no, I thought it was really interesting to see, those two strategies side by side. And for our clients, we blend the two strategies based on their goals, their tolerance for risk, different things. But I do think it's interesting, and to that point of, being more short-term, long-term, having long-term money, just pointing out that the growth, yeah, we raised some cash in the growth, but the, dividend / value strategy is, basically fully invested still, and with that rotation in that area, and again, a little bit different of a what we're trying to do in that strategy. Obviously, it comes with different, approaches to that portfolio, and so I just think it's interesting as you kind of point that out, and I think it's a good indicator in terms of that longer term investing. And you've been working on some, and I think they're almost ready to go, but I'll plug it if anyone out there is listening that wants it, because you've done some amazing work kind of just putting those strategies to paper. So if anyone's just kind of interested in kind of the approaches of both of them, go to the website. You can email us at info@newagewealth.com, or go to our website and contact us that way if you want to see it or have a conversation as to how they're built out and what the approach to both strategies are.
Do you want
happy
me
to kind of walk you through that.
Pop it up or no?
You can kind of just show the page or two of it. I didn't know if they were fully finalized, but yeah, you've done some really awesome work on it. I think it's a great resource for clients or those interested in kind of finding out more. Just kind of seeing and having a feel of what that strategy is really meant to do.
I appreciate that. Yeah. So Ryan was on me. I've spent days on end building the portfolios, but I need to put it into a clean marketing piece to sort of lay out what we're trying to accomplish in each of the portfolios. So this is the alpha strategy, just kind of taking through the objective, the approach, tactics, some of the metrics behind the portfolio, the weightings, as I just showed you there, performance.
It's not on. I don't see it on the screen. I don't. If you're trying to share it, sorry.
Thank you very much. Yeah, I got to.
Yeah.
Thank you. So this is alpha strategy, just kind of going through what we're here to do, the approach, the objective, the metrics, weightings, as I just showed you, performance and inception, year to date, a little bit more, and then that, and then the same thing with the tactical dividend. I'll just flash that one up as well. There's tactical dividend. This will be available on the website. Gives more information. Same thing. What we're here to do in the tactical dividend, metrics behind the portfolio, performance, et cetera, et cetera. And then we'll have one for our third, which is hedged equity, which is our sort of our structured note fixed income fighter portfolio that kind of protects on the downside using options. So we'll have more information on that. But
yeah,
right,
so
well,
if anyone wants to,
thanks for letting me plug that. I
Yeah.
appreciate it.
No, it was good. It was good stuff. I think it's important to see, and great resource. So like I said, if anyone wants to find out more, definitely reach out and can kickstart a conversation, just getting a better feel of what we're doing.
Yeah, that sounds great. I appreciate it. I just read some of the questions. Dollar strong as it gets until interest rate hike worldwide takes place. I don't think the rest of the world's going to be hiking rates. I think call selling, YouTube buying are offsetting each other. Okay, I hear you there. What's your energy outlook and portfolio allocation? Yeah. So it showed you the portfolio allocation. You should be able to flash through there. We're pretty heavy. Energy. Okay, great show. Thanks. I really enjoyed that one. Guys, thanks for hanging around here Friday afternoon. Hope you guys have a great weekend. Markets are stable. S&P down 2.6, Nas 3.1. Rates are still kind of hanging out. VIX still at 28. Dollar up 0.9. Gold continues to do nothing. So we shall see what next week looks like. Looks like all eyes are going to be turned into GDP. But hey, thanks, Ryan.
Good stuff today. Thanks for sharing all that.
Yeah, that was great. Check us out, newagewealth.com. Working with clients every single day. And speaking of, we got to go turn our attention to some clients right now.
It's a good idea.
It is a good idea.
All right,
Stop yabbing on YouTube and go take care of your clients. All right. See you, bro.